Hi, I'm Chris Edgar, co-head of Capital Introduction at StoneX Prime Services here in Stamford, Connecticut. Thank you for joining us for our discussion on investing in funds with an environmental, social, and governance mandate, also known as ESG. StoneX is a global financial services firm dedicated to connecting our clients to more than 175 markets worldwide. With more than 3,100 employees, our global presence includes 90 offices spread across 5 continents. Our prime brokerage group is focused on helping hedge funds, family offices, mutual funds, and wealth managers run their businesses and access markets more efficiently. We've assembled an expert panel for our discussion today. I'd like to introduce our moderator, Steve Yoon, who's an investment officer at the Municipal Employees Annuity and Benefit Fund of Chicago. And our 2 panelists, Anna-Marie Wascher, CEO and founder of Flat World Partners, and Patrick Campo, who's a partner and the director of research at Titan Advisors, also here in Stamford, Connecticut. And with that, I'd like to pass it over to Steve Yoon.
Thank you, Chris. Hello, everyone, and thank you for joining me today. My name is Steve Yoon, as Chris mentioned, the investment officer for Chicago Municipal Pension Plan. We have great panelists with me today to discuss trending topics. And no, we're not here to discuss what will be the next GameStop or the Super Bowl, but we are here to discuss ESG and diversity and inclusion. As Chris mentioned, we have Anna-Marie Wascher from Flat World Partners and Patrick Campo from Titan Advisors. But first, a little bit about the plan and myself. MEABF is a $3.6 billion pension plan established in 1920 by the Illinois Pension Code. We serve close to 75,000 members, and we have close to 30 different unions representing our membership. As for the investments, the fund invests across all major asset classes, and some of the initiatives in 2021 are diversifying our credit portfolio through multi-sector credit and private credits, and enhancing our emerging, quote-unquote, diverse manager program, just to name a few. My role as an investment officer is to make sure that we have enough money to pay our benefits. Jokes aside, as I represent an investment team of 1, my responsibility spans from investment decisions to operations. With that said, Anna-Marie and Patrick, let's hand it over to you. Introduce yourself and your firm. Let's start with you, Anna-Marie.
Great. Thank you, Steve. I'm Anna-Marie Wascher, founder and CEO of Flat World Partners. Flat World builds custom solutions across asset classes solely dedicated on impact and ESG research. And recently, we spun out a technology business to do ESG data analytics and reporting called Eblue.
Thank you, Steve. My name is Patrick Campo, and thank you to StoneX as well for hosting this panel. My name is Patrick Campo. I'm the Director of Research at Titan Advisors. I'm also the portfolio manager for the Titan Eclipse Fund, which is our ESG fund that we've launched in partnership with Flat World Partners. Titan has been around for roughly 20 years. We manage approximately $4.5 billion. We invest in hedge funds in really all strategies. And that includes long-short equity, event-driven, global macro, credit, multi-strat, and quant. We have offices in Toronto, London, and Stamford, Connecticut, and we invest globally.
Thank you, Patrick. Anna-Marie and Patrick, I believe Titan Advisors, the relationship between the two is leveraging off of the Eblue system that Anna-Marie mentioned. Can you elaborate on the system, and how do you view the ESG factors and ESG metrics in the investment considerations? And how do you balance the quantitative and qualitative factors?
Yeah, so, our challenge in the market when developing the strategy behind Eclipse was finding a cohesive reporting tool, both that we could monitor and work with our managers on integrating ESG research into part of their process. And there's 2 sides of that. One is a risk assessment element to the investment process, and then the other is opportunistic thematic ideas that some of our managers follow. And so what Eblue set out to do was aggregate over 20 different data providers, clean that data, and put it in models and formats that would be digestible both for research teams that were new to ESG, but also in a format that we could redistribute reports to our LPs. I think that's really just been an ongoing challenge in the market. To your second question, it's really providing a solution that gives managers access to ESG, because it can be incredibly costly to acquire these types of data sets, but also hiring ESG specialists to be able to interpret and integrate it into existing models. And then secondarily to that, cleaning and vetting the data. So how do we weigh qualitative versus quantitative data? And what we don't want our managers to do, which was kind of what we believe to be the early view of ESG, is do negative screening or just hit certain ESG numbers. That's really not what we're setting out to do. That's where you have issues around diminished performance, potentially because you're isolating certain stocks. And ESG data tends to be backward looking, where we're really focused on developing more forward looking research ideas by looking at things like new sentiment data out of True Value Labs or UN sustainability goal mapping, thematic indexes. If you look at ESG scores today, diversity and inclusion tends to lean towards women on boards or women in senior management positions. So we searched for third-party data sets and indexes that gave us more granularity around diversity and inclusion, both at the company operating level, but also senior management, and more diversity beyond just females.
Thank you, Anna Marie. So can you give our viewers the understanding of what greenwashing means and how the Eblue system that you have help the investors from this greenwashing across the industry?
You know, I think there's something like 14,000 labeled ESG funds in the market today, and the flows of capital have doubled this year from last year already, or from 2019 to 2020. And ESG is such a significant range in how managers or asset managers are utilizing that term. And many managers, it's a very, very low bar. And you know, Patrick is really leading a lot of the research and sourcing new managers, and him and I speak every day about this. We're always in the market. And many times when we speak to managers that might have ended up in another ESG portfolio, that manager will say, well, we don't do ESG, but we do this one screen and we won't invest in oil and gas. And for us, that's not really good enough. And it's not going to differentiate that manager in the market. Those types of managers are not going to end up in our portfolio. So greenwashing historically is when managers claim to be doing ESG, but really are doing very, very little around the subject. And in fact, you'll see many mutual funds or ETFs with ESG in it have Exxon as their top 10 holdings, right? Or a tobacco company. And that's simply because the PR firm of that company has been able to work with the large data providers and get themselves a different ESG score, and therefore they slipped through the cracks. And that's what we're really working on avoiding. So it's about moving forward, and fortunately there's much better regulation coming into the market, specifically out of the EU and some of the EU taxonomy rules, some new regulations, or at least chats on regulations coming out of the SEC, that many of the managers that once labeled themselves as ESG will have to rethink that label, because they could get essentially fined or in trouble by lying without being able to prove that they follow processes. And what we really believe in as Eclipse is it's not that we're just allocating to ESG managers or we're themselves ESG. We're talking to them every week, every month, engaging with our ESG team. It's a partnership model. It's very high touch. We can see how they're utilizing Eblue. So if you even attempt greenwashing, you're kicked out. So, you know, we have a no greenwashing, no pink washing, which is about diversity and inclusion. There's all kinds of washing these days when it comes to ESG issues.
Right. Since it's essentially a window dressing that's done by the investment management firms. So, you know, Patrick, anything to add onto the greenwashing comment?
No, I would say it is definitely an issue, especially given the amount of capital that's come into this space. And that is, we've seen it in the hedge fund landscape. That is, many managers will simply type out a piece of paper that will be their ESG slide and put it into the marketing book, and maybe even subscribe to a data provider. And personally, I think that's one of the benefits of allocating to a group like Flat World Titan LLC, and that is our joint venture. Part of what I say is our joint venture was formed almost to ensure against greenwashing. And that is because we're really taking such a high touch approach towards investing in hedge funds. We're talking to the managers constantly. We're reviewing their engagement on the Eblue system. We're helping them create an ESG policy. We're reviewing the positions and the processes with them on a monthly basis. Because we're taking all of these steps, it acts as an insurance layer against greenwashing. I think what we've seen, and that's one of the attractive qualities that we bring to the table. And that's what we've heard from some of our clients. And that is, people have said, they could go direct and they could just sort of subscribe to a manager of some sorts and invest, but they wouldn't necessarily have that oversight to monitor that manager.
Right.
I think that's what we offer.
Yeah, there's certainly a value in managers, the values they guys provide by overseeing these managers, certainly. I could say that for fact as we use managers programs for certain asset classes as well. So here's a question related to greenwashing. So our plan recently received a request to identify our fossil fuel exposures, and we get these type of requests very frequently from the public. So with that said, can you kind of step back and talk about the evolution of ESG and the archaic way of looking at pure divestment or isolation of stocks that you mentioned earlier? Patrick?
Well, I think I should defer to Anna Marie, because you can talk about the history of ESG and where it's gone from just pure divestment, negative screening to where it is today.
Yeah, I mean, I think, at the start of really ESG, and many people know this, but it was really the nuns in the Catholic Church that took a negative screening approach. And, with the momentum of change, and we see this consistently still today, is political change often drives thematic ideas or research around ESG. And so apartheid was part of that many, many years ago. And then more recently, when you look at Black Lives Matter, we've seen a lot of new indexes and push around diversity and inclusion. And these affect public stocks. There are CEOs that have had to step down because of unfair promotion or hiring practices. There is more indexes. The Biden, era is changing the way companies have to report on diversity and inclusion and ESG regulation. And so a lot of those political changes drive momentum in our industry. Beyond that, what has been the most significant shift, so in 2015, when we launched Flat World Partners, we saw the majority of the market have a strong interest in private market allocations towards thematic impact ideas. And that was still slightly considered below market returns because it required very specific research to understand themes that were happening in the market, where managers were allocating capital, whether there was enough follow-on capital to drive the success of those businesses. And we've seen that really creep into public markets. And that's why 2 years ago, we approached Titan Advisors about a partnership in hedge funds, because we felt like it was the right timing in the market. Our clients went from wanting to allocate 90% of their capital into private markets into, a dramatic shift into public markets because of ideas like, most recently Rivian going to IPO, the electric truck company. You see shifts in the behaviors of companies that really can make them ESG or environmental focused companies. Transition energy is a discussion. So solar stocks used to be kind of the, pink slips of the market, and now they've really become mainstream. And so understanding where companies are on their evolution towards carbon emissions. There was an article today about United investing in electric short-term air transportation. And so these themes are actually, in some instances, what are driving performance in the stock market. COVID basically put, gas on the fire, because when you think about all the themes that impact investors have been investing in, like remote education or equal education for all, access to Wi-Fi in remote areas so kids could have access to education, or people can work in remote regions, reduce carbon emissions by remote workforces. So Zoom has been in many impact investors' portfolios for a long time. So when you have these big, black swan events, impact and ESG tend to do incredibly well. And that's becoming really a huge ramp up in terms of what's happening in the ESG market and impact market. And we continue to see this. People are moving now away from just the ESG assessment into thematic impact mapping, which is what we're focused on in Eclipse. And so that highlights examples like the UN sustainability goals. So mapping to health and wellness, reduced inequalities, climate change, and improved infrastructure. And so that's where we see the market going. That's where we try to think about our impact mapping and ESG assessments, not just, is this portfolio over or under a 50 score, which honestly, managers can lie, because you can pick whichever data provider you want. You can reweight that data and you can get the score you need to look good.
Mm-hmm. Thank you, Anna Marie. So there's a rather new legislation for us here in Illinois, in the Illinois Pension Code effective January 2020, that requires us to look at ESG data whenever we're making investment decisions, whether that is to onboard a manager or stock selections by our managers. So it is rather new, and we're still exploring how we can best implement this within our portfolio. So with that said, what are some of the trends, or obviously you just talked about the trends, but what are some of the things that we should be paying attention to, and tips for the new investors coming into this ESG investing?
Patrick, do you want to?
I get started off. What I would say is, when looking at the trends and looking at the data, I think it's what we've seen. It's that it's very easy to get caught up in a particular score. And as Anna Marie just alluded to, there are many different, different ways that portfolio managers could weight their portfolio. There are different scoring, different data providers that provide different scores. The data is not necessarily updated regularly. So you could have the same stock that could have different scores. So to the extent that I think one has to, when really viewing ESG, what I've found is that the most advanced people in ESG are not necessarily using a black and white metric to define a particular manager. They're really using an approach in terms of a readiness approach, if you will, and that is, where is the manager philosophically on ESG? Where are they? What are their views towards ESG risk factors? Are they getting the data? Are they using it? Are they incorporating those risk factors into their current process? How do they run their firm? Are they running their firm with an eye towards ESG? Do they have salary pay gaps? Do they dedicate a percentage of their interview slots towards women and minorities? Are they signatory to the UN PRI or another group like PRI? Do they have an ESG policy? Do they have a diversity and inclusion policy? Really, those seem to be some of the best metrics to really gauge whether or not managers are making a real effort towards ESG. If they simply take a portfolio and score it, I've found that those tend to be managers that might be 4 or 5 years behind the cutting edge ESG research that we're seeing today. And really, I thank Flat World for that, because I think Flat World was very early to this move, and they've been pushing us to move away from the scores, and really look at the manager, get to know the manager and understand their approach, understand where their views are with regards to ESG. And that really is the best.
Mm-hmm. So let me ask you this. What do you say to the old adage of ESG investing can leave returns on the table?
Yeah, I'll jump in here too, and then I'll let Anna Marie finish. What I would say is that's definitely not the case. For the Titan Eclipse portfolio, when we first launched it, our founder, George Fox, said, we're going to launch this portfolio, but it has to perform. It has to perform. And what he was really trying to say at that point was it can't underperform and we can't leave money on the table. So I originally thought with this old methodology saying, well, aren't we at risk of underperforming if we're limiting ourselves towards ESG? And what I found was, again, it's going back to the old way of thinking versus the new way. ESG investing is really not about cutting things out. It's really about incorporating different data sets and different risk factors into your current process. So hedge fund managers, and we with our managers, we give them a very wide avenue to invest. There are very few areas that we put on a no-go list. In fact, in fact, many of the areas that we put on this no-go list, the managers were not investing in that area to begin with. But what we are saying is incorporate these risk factors into your current process. And if you're going to invest in those stocks and you feel like there are a number of risks, make sure you're being fairly compensated for that risk. And are you? And if you have the belief that you are being compensated, just record it and track it and honor that risk and make sure that you're aware of it. That's number one. So it's really looking at it from a risk standpoint. Number two, we have looked at the data is showing, and there are some studies out there that are saying that the higher, if we wanted to go back and just look at what are some of the better scoring companies, and I'll use that term loosely, but there is data out that actually shows that those companies, they tend to outperform over a long term. Now you could say either A, they're outperforming because better companies that have better governance and lower employee turnover and understand climate risk and the effect that it can have their business, they tend to outperform because they've already sort of been reducing those costs. Or B, you could say they outperform because any management team that follows ESG best practices tends to follow a number of other best practices. They tend to be well-run companies with an eye towards the future. And this is just part of that mindset. So I would say from my standpoint, I know when we first started this project with Flat World 2 years ago, I personally was concerned, could we do this? And as we've gone along for the past 2 years, I'm not only convinced we can do it, but I believe that we're going to outperform. So
I mean, I think the performance of the managers in the portfolio really speaks to that. And as part of our process, what's a little bit unique is we went out, there's a challenge, especially for larger allocators like yourselves, to be able to allocate to the newer emerging ESG managers because they don't have the AUM or the track record that would be required. And so there are some of those managers in our portfolio that we think are really best in class ESG, doing thematic research. And by the way, those were probably our best performing managers in the portfolio last year, in comparison to large institutional hedge funds, both in credit and equity, that have been doing this for 10, 15, 20 years. And what we did is we developed an ESG readiness assessment. So we spoke to the managers to understand what their current processes are, both at the firm level. So do you have a diversity and inclusion policy, to what Patrick was speaking about? Do you have a governance policy? How do you assess risk in any position you're taking in the portfolio? And so we weren't being very specific around ESG, but what we were specific about was their process and whether we believed that in their process, it would be easy to integrate environmental and social risk assessments beyond governance, as well as are they taking an opportunistic approach to themes that they're seeing in the market that relate to ESG. And many of the managers were, without taking a greenwashing approach and defining themselves as ESG, or really understanding that that's where the ESG market had gone. And so in that regard, our managers are being, probably to Patrick's point, really detailed around what their processes are. And even during, March of last year, they were faster to, in fact, turn over the portfolio or have a risk approach to the exposure and then re-entering the market. So my general sense, and Patrick can say differently, it felt as those managers actually were more prepared to handle the volatility in the market. I think that comes in two ways. There are enough studies that diversity at the firm level improves performance. There's a great Harvard test case where they put, the strongest chickens all in a pen together, and they ended up plucking each other's eyes out, where the mixed team actually performed the best in producing eggs. And so, there's enough case studies where people of diverse backgrounds perform better as a team versus purely competing against one another. And so, we hope to see more diversity, and we're working with our teams to improve the diversity and dynamics across their organizations. And then again, on ESG issues and integrating data analytics through Eblue, we're giving them access to new data sets that they would never think of looking at before, and whether there's opportunities in those data sets to find new ideas or avoid potential risks in the portfolio by deciding, what, this is a risk I don't want to own. So.
Thank you, Anna Marie. Thank you, Patrick. So let's shift the gears here to diversity and inclusion. Obviously, you just touched up on a lot of diversity, and diversity and inclusion is certainly a subset of ESG. With all the social inequality and unrest that's going on around the world, and DNI has become an important factor. And it certainly is for MEBF and a lot of the Illinois pension plans here. Pension code here in Illinois encourages us to invest with the minority and women-owned asset managers. And not only that, we also review their diversity and diversity of the organizations, as you guys do with your underlying managers, and encourage our managers to work further with the minority and women-owned brokers. So we also have emerging managers program, and we have diverse staff and diverse board members as well. So as you mentioned, so diversity brings ability and able to bring alpha to the portfolio. And with that said, what type of DNI initiatives do you have at your own organizations?
Well, we are a women-owned organization. Over 50% of our investment research team is female and diverse, and we have a very strong hiring policy around diversity and inclusion. So, it's in the ethos of our organization. I do think it takes it coming from the top and developing that over time. And we always, push ourselves harder. We're very open in terms of discussions around diversity and inclusion, and making sure that, every employee feels equal across the firm. We do training around it. We try to, think about different ideas and speakers and pushing the boundaries. And even in our research, we have a specific, similar to yours likely, checklist when seeking out MWBE managers, minority or women-owned. And so we try to create an equal playing field with those managers that maybe don't have the same track record or AUM as some larger male managers because of, historic factors in allocations. And we want to try and get those managers over the hurdle because of the quality of research or their performance. So it's something that we really work on at the Eclipse level. And then I'll let Patrick speak to it a little bit at Titan, but it was, something that was an issue for us. And we really want to be helpful in this process. With our managers, we ask them to develop a diversity and inclusion policy. We will help them write those policies if they don't have one in place. As part of that, they're required to interview at least 30% diverse or female candidates. And we're centralizing that HR process by collecting a database of resumes of diverse and female candidates for our managers. We will support them when they have a new role available, looking out for new employees, as well as, some of the challenge on small teams is if you're the only diverse employee, it can feel isolating at times. And therefore, we're also setting up a mentorship program. So every manager in our Eclipse fund designates at least a senior member of their team as a mentor, and they can be designated a mentee from another fund that's a diverse or a young female making her way up in her career. so that they have access to someone that can be their sponsor as they develop their career. And so really thinking about, okay, what sets people back? Why is the industry not moving forward? Why are not, more diverse individuals in the hedge fund industry? We're trying to create those solutions. There's some really great technology solutions that can help monitor diversity and inclusion that we're looking at implementing as well, and providing additional support and training. So we're firing at all levels on the topic.
Absolutely. And just to add from the Titan side, it's diversity and inclusion is very important to us here at Titan as well. As Anna mentioned, it's the joint venture between Flat World and Titan. It's 51% owned by Flat World. So it's Flat World, of course, is owned and run by Anna Marie Wascher and Kate Starr. We have an ESG investment committee that's been meeting every month for roughly a year now. 3 of the members are female and 3 are male. So we're diversifying our investment committee level. And then at Titan, for new hires, what we've committed to doing is really not only 30%, but we're really dedicating at least 50% of our interview slots towards women and minorities and making a strong effort. From a manager selection process, diversity is incredibly important within our managers. We've committed to adding at least 1 or 2 managers that are either female or minorities to the portfolio currently. The challenge that we have, it is a dual mandated fund, and it's just the sheer numbers. And that is, unfortunately, there are not currently a number of or a lot of female-run hedge funds or minority-run hedge funds. So in a span of thousands, they're fewer than 50, and that's something that we'd love to see improve. But we're on top of these managers, and we're doing work on them basically every day, and we're going to be adding those managers to our portfolio.
That's great to hear. We've also expanded our relationship with our hedge fund manager to expand our relationship to form a emerging manager program within the portfolio as well. So we're seeing a lot of great candidates come through. So maybe I'll pass it on to you next time I come across someone.
Love that. Yeah.
So Anna Marie, you mentioned that you're obviously Flat World is a woman-owned shop. You both mentioned that, and Titan Advisors, could be considered a emerging firm at a 4.5, depending on who you ask. Here in Illinois, emerging is a 10 billion and under, and owned by a minority, so a little bit unique in that regards. But let's step back a little bit. So, and can you talk about and this question to you, Anna Marie, talk about challenges that you faced as a female-owned firm as you were coming up to forming a Flat World, and any advice for those that want to follow your footsteps?
Yeah, I mean, I have lots of great stories, but it goes 2 ways, right? So I think, unfortunately, there's just a general consensus or assumption on what your role is within an organization. It's something as small as, quite frankly, when you're at a conference, people don't come up to you because they don't think you're worth speaking to. The number of times someone comes up to me and goes, what fund do you raise money for? Or you should introduce me to your boss. It's just the first impression assumption sometimes that can automatically put a wall up, because you have to work that much harder to develop your network or have access or respect in the same way that, unfortunately, a man can just walk into a room and sometimes dictate that level of respect, which is a more personal thing to share, but I've heard it multiple times and it can affect you. At the same time, the amount of due diligence or research or proof of concept or performance that you have to show before people trust you with their capital, which of course everyone needs to gain trust and respect, seems to be a much higher bar than some of our equal parties. Now, it was a very, very different experience, and it's not always just male versus female. That's not our point here. We spoke to many different other fund of funds, and when speaking to them and saying, hey, this is what we'd really like to go out and do in the market, we want to create change. Of course, I knew going into it, Flat World couldn't do it alone. We didn't have the respect of the hedge fund industry And Titan had years of experience, had performed in multiple market cycles, also had the respective managers that had become large managers that they seeded. And, when speaking to different groups, many of them said, yeah, sure, we'll give you, 10% of this deal, but you don't have voting rights on the investment committee. It's our thing, not yours, even though it was our concept. Whereas George Fox, the CEO of Titan, came in and saw this as a real partnership, and in fact gave flat rolled 51%, which I think really speaks volumes to the kind of firm that Titan is. And quite frankly, that's very few and far between to get that type of partnership going, and the equality and respect of a young and very different organization led by, a set of females to a, industry leader like Titan has been over the past 20 years. At the same time, when growing flat rolled, we didn't have access to capital. So, we had very similar companies launch that were given $3 million in funding and a team behind them, and even lines of credit at institutions, whereas we had to self-fund and bootstrap before we could, get ourselves off the ground. And so there are constantly challenges and hurdles. Now, it's not always a female versus male or diversity versus inclusion or an impact versus non-impact, but these are things that we really want to support our managers. We're very aware of, we've experienced ourselves, and I see the industry changing very quickly. Finally, women are a little bit more in the spotlight, but it's still a challenge. On the venture side, we raised capital for Eblue, and I love my VC partners, but I was the first female they backed, and they've been around for a long time, fintech focused, tremendous support, but it was a challenge to find the right partner in that regard. Female funding into VC founded or startups has actually declined this year versus previous years, or 2020 had less than like 2.8%, and I think 2019 had 2.8%. So, we say we're moving forward, but sometimes it seems like we're staying in place, and we really want to make that kind of shift and help women become equals and rise up in the hedge fund industry and have the ability to really scale their funds and be on the next Milken conference main stage with, the Blackstones and the KKRs of the world.
No, I think that's a great story, and I thank you for sharing your personal story, and that was very insightful, and congratulations to your success, and obviously many more years to come. And let me ask Patrick, obviously, while I was doing research in your firm, one of the Titan's objective was to source and provide early stage investment in emerging hedge fund managers, sorry. And, so what type of advices would you provide not only to emerging firms, but for firms owned by diverse managers?
Well, it's what I would say is it's a great question. Titan, the culture of Titan was really founded on this belief that some of the best times to invest in a hedge fund manager is early within their life cycle. That tends to be where relationships can really get formed with the hedge fund manager, capacity agreements can be secured, fee reductions could be obtained, and also the returns can be a little bit higher as the managers are earlier in their life cycle. They're very hungry, they're very dedicated. Having said that, it is very difficult, especially in these last few years, for emerging managers to get off the ground, and for any hedge fund manager, and for a woman or minority to launch a fund in this market, I think it's also very difficult as well, because I think there are biases against female and minority managers that they must overcome, as Anna was just speaking to. And by the way, just to give Anna credit, I mean, I've worked with Anna now for 2 years, and she's one of the most professional, driven, ambitious individuals I've ever worked with. So it's amazing seeing her grow her business, and it's really a true pro. So, but getting back to the hedge fund side, it's I think what advice I would give them, it's really just trying to find that balance between raising the money and staying glued to their portfolio and generating those returns. I don't think there are very many shortcuts. I think if I were a manager and looking to raise money, I would tell them just don't give up, because it doesn't take much. It only takes one or two allocators to get them to that critical mass where they can have the whole world look at them. But it's difficult. But by the same token, they have to make sure they don't fall into a large drawdown. They can't dedicate 100% of their time to marketing. So they have to be careful to be able to thread that needle between marketing and also running money. And finally, I would encourage them to don't have any preconceived notions. And that is, be willing to speak to anybody, a family office, an endowment, a fund of funds. If somebody offers somebody a managed account, explore that. Think about different ways that they could raise that first bit of money. I think what's hard about today is that it's hard to raise money today, but what's also good about today, it's that I think nobody really looks down on a manager that takes alternative routes to get to a critical mass. So in the past, people would look down on managers that took seed deals. Nobody looks down on a manager that takes a seed deal today. Just like managed accounts. Nobody looks down on a manager that cobbles together a few managed accounts. So keep an open mind, think about what investors need or want, and be willing to have those conversations to find out if they can figure out a way to meet an investor halfway. And then hopefully that manager will get to a point where they can attract money outside and they're no longer emerging.
Mm-hmm. Thank you, Patrick. Yeah, I certainly managers need to focus, hone in their skills, and have an open mind and flexibility to listen to their clients' needs. Definitely. So I'm going to stop here for now. That's it. That's all the prepared questions I had. So I was going to close up and just give a closing remarks, I suppose. If that's all right with you guys.
That sounds great.
Perfect.
All right. Well, that is all we have for you folks. I hope today's discussion on ESG and DNI have been helpful and provided more insight into this marriage between Flat World and Titan. It certainly has for me. I want to thank Anna Marie, Patrick, and StoneX team for this session. Have a good one, everyone.
Thank you.
Thank you.
Thank you, Nick. I would just like to add on behalf of StoneX, we really appreciate Steve, Anna Marie, and Patrick, you taking the time to address such an important topic to our industry. We really appreciate it, and thank you very much.
Thank
Thank
you.
you.
Thank you.